Welcome to Modeling Monday, where I examine a real-world financial situation using Microsoft Excel. In this episode, we will analyze the relationship between outstanding margin debt and the stock market. So what is outstanding margin debt? Margin is the amount of money that investors have borrowed using their investments as collateral. According to Investopedia, margin debt is the dollar value of securities purchased on margin within an account. Margin debt carries an interest rate, and the amount of margin debt will change daily as the value of the underlying securities changes. Or another definition, the aggregate value of all margin debt in a nation or across an exchange. Why is this important? Some investors believe that high margin borrowing is a sign that the stock market is overbought and likely to decline. This may be a familiar chart, and also the chart we will build in this tutorial. This shows the outstanding amount of margin versus the S&P 500. Many people refer to the peaks as opportunities for the stock market to decline, showing that investors are too optimistic about stock prices. So in this tutorial, here are the steps we will follow. We'll download outstanding margin data. We'll clean up that data. We'll then download the S&P 500 historical data. We'll align the data of those two categories by date. We'll analyze that data, and then we'll chart it. I hope you find this tutorial interesting and a lot of fun. Let's get started. So the first step in this tutorial is to download the outstanding margin debt data. So we're going to go to trusty Google here and put in outstanding margin debt. Here are the results from that search, and we're going to go to number 2 here, NYSE data factbook, and this shows the amount of market credit for securities. We're going to click on that link, and here are the amount of margined securities. Here's the amount of debt that we're most considered with. The other columns we really don't care about. So in this case, they're separated by 10-year periods, by decade. So we're going to start by downloading this data. Click the little Excel box. We'll see it pop up. And we've got our data. Now we're also going to do the same thing. If you click here, from 2000 to 2009, do the same thing. And then all the way back to 1990 and do the same thing. And then you'll click on this icon and download all 3 of those. Next, we'll combine that data. So you should have now these 3 different workbooks having all the data going back to January 1990. As you can see, the columns don't completely line up. So we're going to have to do a little bit of editing to clean up this data. So we can start with any of these we like. The first column is the only column we're really interested in past the date. So I'm going to begin by just deleting these rows. Delete. Delete. There we go. We'll do the same thing over here. Delete. Delete those 2. And third. And delete. And that's what we have. So here, we'll copy all the way down. We'll do the same thing here. Oops, I got an extra column here. And delete. And then we'll copy this data just the same. And you'll see it ends on April, as this will get updated a little bit late. So we're about a month behind. Excellent. And we'll see that I've copied these in order. Otherwise, you can do a sort. Highlight columns A and B. Actually, I'm going to expand this. Highlight columns A and B, and then I sort from A to Z. You can also go to data, sort, and same thing, oldest to newest, and you'll get it just like that. And this data is the amount of margin debt we have from January 1990 all the way through April of 2016. Next, we'll do a little bit more cleanup. Now we'll do a little bit more cleanup. One thing of note, if we go to the very top, and I'm just going to hit Control Home to take us to the very top, select entire column A, and we are now going to choose what type of number we want referenced. And so I'm going to go date. Now, if you noticed, it now changed it from January 1990 to January 1st, 1990. However, the data we've downloaded is from end of month. So unfortunately, our dates don't match up. Luckily, there's a quick and easy way to do this. So we'll go back to our data, and I'm going to insert a column, and all we're going to do equals the previous month end minus 1. And that'll give us the last day of the month. We can copy that down, click on the lower right corner, and we'll see now we have month end data. So copy, and we'll paste special just the values. And now we can delete column A, right click, delete. And now it shows the correct how we ended the month on that date. Now when we match up the S&P 500 data, it will make more sense because it will be truly month end. Next, we will get data for the S&P 500. We'll go to Yahoo Finance, which is finance.yahoo.com. On the home page, you'll notice that the primary index listed is the S&P 500. So we'll click on that, which will take us to a description of that index. And on the left, it'll give us the option of historical prices. So let's click there. Fantastic. And then if we scroll down to the bottom, we'll notice first that this is set on daily, going all the way back to 1950. It's a lot of data, but we'll just take it all, and we'll download this to spreadsheet. So let's open the spreadsheet once it's downloaded. And here is our data. Now we're most interested in the close, so we'll go ahead and delete columns F and G, as well as B, C, and D. And now we have the date of the close, and then the point total of that close. We can now copy columns A and B, copy, go back to our original spreadsheet that has the margin data, and I'm just going to paste this randomly here. And actually we could paste formats as well. Excellent, so now we have date and close. In column C, we're going to do a Vlookup, so it's equals Vlookup, open our quotes, and what are we looking up? We're trying to match the date of the margin outstanding with the S&P close, so we're going to try to match A1. We're going to look for that here in the table array, which is these two columns. That is our entire table. We're going to look for that data in column 1, and then when it finds that data or something close to it, it'll respond in column 2, which is the I category. Let's see how this works. Well, it's showing us an S&P value of 17, and if we copy this all the way down, we'll notice it does the same thing. Well, what's happened is it's looking for data, but it's in the wrong order. We have the most recent periods at the top when we need them at the bottom. So all we're going to do is hit sort, and now we see that these data values have changed. And we see the data of the S&P 500, which really should not be in dollar form, but point form. So I'll just change a little formatting there. And this is going to go all the way down till 2016. Now we've only got data here to 430, so we can go ahead and then delete these amounts. So let's delete this. And we want to just shift up. We don't want to shift across. And now since these are formulas, let's take the formulas out. So we're going to copy, paste special, just the value. So now they're a hard number. They're not in any valuable form, in any value form. And let's go to the top. So I'm just going to hit Control Home. We can delete this. Now, one of the things that we can analyze, and we see these raw numbers here, but we can use what's called correlation. And correlation states just how do these two things move together or not together? And that formula equals CORREL, which is just the short for correlation, array 1, and that's just this column, B, and then column C after a comma. And that's going to compare these two columns and how do they correlate together. And if we hit enter, we see that it's got a correlation of 95%. So 95% of these 95% of the time, these two data sets, columns B and C, move together. Means they're highly correlated. Another way we can do this, and this is not going to be part of our charts, that's just for our analysis, is look at the ratio. So let's equals B1 divided by C1. And let's take a look at this ratio. And how has the ratio changed? And we see how this ratio over the course of the years has varied. Looks like a 99. It goes down in the 80s, 120s, 180s. But it stays within a particular range, especially recently, in this 200 range. And when we chart it, it'll make a lot more sense. So let's go ahead, go back to the top, and begin building our chart. We will begin building our chart by entering in, so I'm going to insert a line, and then we're going to enter in some headings here. This will be date in A1, B1, this will be margin, this will be S&P 500, and this will just be ratio. Fantastic. So the first thing we're going to do is highlight B and C, and let's insert a chart. And we're going to use a line graph for this. So line, and I'm just going to use a very basic chart here. And there we go. And that is telling us exactly nothing. So we have to format this chart. First, let's select our dates. So let's select our data. And we don't want to use these categories. First we have margin, then we have S&P 500. We're going to use the range. So let's select the range. And these are the dates we are going to use. Shift key, end, and then hit down. And then we're going to hit OK. And let's hit OK, and let's go back to the top. So Control Home. Well, that's looking a little better. And now, because these are on different number levels, the margins are very big numbers. If we just take a look at these two examples here, one's at 32,000, the other one's at 329. So we're going to use two different axes for this particular chart. I'm going to make the chart a little bigger. I'm just going to drag it a little bit here, move it over so we can, oops, didn't want to do that. I want to move the whole chart over a tad, so we're going to put it right here. Now, the blue line represents the amount of margin we have and looks at this scale at the left. Now, we have the S&P 500 here that we also need to work with. So let's click on the S&P 500, which is the orange line. We're going to right-click, Format Data Series. We see our choices pop up on the right. We're going to click Secondary Axis. So now, their data points are going to line up on the right. And as we saw before, there's a 95% correlation, that relationship between the two, that they move in the same direction. So this is the chart I opened up with, and this is how we've created it. We can give our chart a title. In this case, I'm going to call it Margin Debt versus S&P 500. And done. Now, one of the other areas for analysis that I'd like to do is analyze the ratio of the margin to S&P 500 versus the stock market itself. So next, we can highlight these two columns, insert, and we'll do the same thing. And here's the graph there. Now in this case, and we'll just scroll down a little bit. I'll also make it bigger. We run into the same issues. So we'll start by formatting the date. Format access. Oh, my apologies. We're going to select data. And edit. And let's select Shift End and the down arrow. And OK. And OK. So let's scroll up and starting to look better, and we're going to do the same thing. We'll right click and format data series, and it should automatically populate on the secondary axis. So here in this case we see the S&P 500 now in blue and the ratio of margin to the S&P 500. And if we just take a look at this data and perhaps even right click and add a trend line, and we'll just do linear is fine, we'll see that that ratio is just merely trending up. So despite some dislocations, it fits pretty nicely this general trend up that more people are just generally borrowing on margin over the last 25 plus years. So the question is, what can we infer from creating these two charts? Well, we see first and foremost that there is a high correlation between margin debt and the S&P 500, as indicated by not only our correlation calculation, but also the fact that the lines fall pretty close to one another. When comparing the ratio of margin to the S&P 500, we notice that it's a gradual trend upward, and especially in this period of time, from say 2007 on through 2015 and 16, it's staying relatively range bound. So even though the market has had significant ups and down, the ratio of margin outstanding to S&P 500, the level, is pretty stable, meaning people are borrowing roughly the same rate for a period of time, whether the market goes up or down. So it's not necessarily a cause and effect relationship, but there is correlation between the two statistics. I hope you enjoyed this tutorial and found it informational. See you next time.